For 6 years in a row, one company was named the most innovative in America. It was the seventh largest corporation in the United States, with reported revenue of about $111 billion in the year 2000 and roughly 21,000 employees. Its stock traded above $90 a share. A little over a year later, that same stock closed at 26 cents. The company was Enron, and its most important innovation was not in energy trading or pipelines or the online marketplace it built. Its most important innovation was accounting, the art of making debt disappear and turning tomorrow's hoped-for profit into today's reported earnings. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection with about $63.4 billion in assets, the largest corporate bankruptcy in United States history at the time. The collapse wiped out about 600 jobs and liquidated nearly $2.1 billion in pension plans. This is the story of how a company that looked like the future of American business was, underneath, an accounting machine, and how that machine, once exposed, destroyed the company, its auditor, and the retirement savings of thousands of people. Enron did not begin as a symbol of fraud. It began as a pipeline company. In 1985, Houston Natural Gas merged with Intern North, and the combined business was renamed Enron the following year. Its original work was ordinary and physical, moving natural gas through pipelines across North America. What changed Enron was an idea. Rather than simply owning pipelines and selling gas, the company decided it could become something closer to a financial institution for energy, a firm that made markets, traded contracts, and treated energy itself as a financial product. Over the 1990s, Enron built a vast trading operation. It traded contracts for electricity, natural gas, and eventually a wide range of commodities, and it launched an online trading platform during the internet boom. On the surface, this was a genuine business transformation, and for a time it produced real growth. Enron rose as high as 7th on the Fortune 500 list and was celebrated in the financial press as a model of reinvention. But the transformation carried a hidden cost. A trading and markets company lives and dies by its reported earnings and its stock price. Enron's culture came to revolve around one goal above all others, keeping the reported numbers rising quarter after quarter to meet Wall Street's expectations. Stock tickers were placed in the lobbies and elevators. Growth was not a byproduct of the business. Growth was the product. That pressure, the need to always show more, is where the accounting began to bend. The culture reinforced it at every level. At budget meetings, the target earnings were not always built up from what the business could realistically produce. According to accounts of the company's internal culture, the number that mattered was the number needed to keep the stock price up, and that figure could become the goal even when it was not achievable through normal operations. When the objective is a stock price rather than a sustainable business, every quarter becomes a problem to be solved by whatever means are available. Some of those means reached beyond accounting. During the California energy crisis of 2000 and 2001, Enron was later found to have profited from trading strategies that exploited the state's deregulated electricity market, selling power at inflated prices while the state's utilities strained under the cost. That episode showed a company willing to treat markets themselves as something to be worked around rather than served, the same instinct that shaped its accounting. And the rewards flowed upward. Executives held enormous quantities of Enron stock and options, and as the company's reported success grew, so did the paper fortunes at the top. That created a powerful incentive to keep the reported numbers rising because the numbers were not abstract. They were tied directly to personal wealth. Two techniques sat at the center of Enron's rise, and both would later sit at the center of its fall. The first was mark-to-market accounting. In a traditional business, a company records revenue as it is actually earned. Under mark-to-market, a company can record the estimated future value of a deal at the moment the deal is signed. If Enron entered a long-term energy contract, it could book the projected profits of that entire contract immediately, profits that might not materialize for years, if ever. The appeal is obvious. Mark-to-market let Enron report large earnings up front, but it created a trap. Once you have booked tomorrow's profits today, you need even bigger deals next quarter to show growth. And if the projected profits never actually arrived, the gap between the reported numbers and the real cash had to be hidden somewhere. That is where the second technique came in: special purpose entities. Enron's chief financial officer, Andrew Fastow, built a network of these entities, separate partnerships and companies with names like LJM, Chuco, and Jedi. On paper, they were independent. In practice, they were vehicles Enron used to move debt and losses off its own balance sheet. The mechanism worked like this. When a deal soured, or when Enron needed to hide borrowing, it could transfer the problem into one of these entities. The debt still existed. The losses were still real. But they no longer appeared on Enron's financial statements, so investors looking at Enron saw a company that appeared cleaner and more profitable than it actually was. One example became central to later investigations. To keep certain losses off its books, Enron used entities backed in part by guarantees tied to Enron's own stock. That created a dangerous circularity. The structures designed to hide Enron's weakness depended on Enron's stock staying high. As long as the share price rose, the machine held together. If the stock fell, the hidden structures would begin to unravel and expose everything they were built to conceal. For years, the stock did rise. Enron reported growing profits. Analysts cheered. Executives were rewarded with stock and options worth enormous sums, and the public image of the company grew more impressive even as the accounting beneath it grew more fragile. There was a deep irony in that image. Enron was named the most innovative company in America by a leading business magazine for 6 consecutive years. The praise was real, and the market believed it. But the innovation the public admired, the trading floors, the online marketplace, the reinvention of an old pipeline company into a financial powerhouse, sat on top of an accounting structure that was quietly doing the opposite of what innovation is supposed to do. Instead of creating new value, it was concealing the absence of it. One transaction later became a case study in how the concealment worked. Enron had a joint venture with an outside pension fund, and when it wanted to buy out that partner without showing the resulting debt on its own balance sheet, the finance team created a special entity to absorb the obligation, funded by borrowing that Enron itself effectively guaranteed. The debt was real. The guarantee was real. But because the entity was treated as separate, none of it appeared where investors would see it. Multiply that pattern across many deals and many years, and the published version of Enron drifted steadily away from the real one. The rise and the risk were the same structure, viewed from two sides. The turning point came in 2001, and it came from inside. In February 2001, Jeffrey Skilling became Chief Executive Officer, with founder Kenneth Lay remaining as chairman. In August, Skilling abruptly resigned, and Lay resumed the role of CEO. That same month, an Enron vice president named Sharon Watkins sent Kenneth Lay a warning. She cautioned that the company could implode in a wave of accounting scandals, pointing specifically at the Fastow partnerships. It was one of the clearest internal alarms in modern corporate history, a senior insider telling the chairman, in writing, that the accounting could destroy the company. Outside the company, analysts and journalists had also begun to dig into Enron's publicly released financial statements, asking how a company could report such consistent profits while generating so little visible cash. There was another detail that would later draw intense scrutiny. As the warning signs mounted, several top executives sold large amounts of their Enron stock, in some cases tens of millions of dollars worth, while the company publicly projected confidence, and in some cases, encouraged employees to keep buying shares for their retirement accounts. The people with the clearest view of the company's condition were reducing their exposure, even as the people with the least information were being encouraged to increase theirs. Then the numbers broke the surface. In October 2001, Enron announced a large quarterly loss and disclosed a reduction of about $1.2 billion in shareholder equity, tied in part to Fastow's partnerships. The Securities and Exchange Commission opened an investigation into the transactions between Enron and those entities. Now the circularity turned against the company. As the accounting problems became public, confidence fell. As confidence fell, the stock fell. As the stock fell, the special purpose entities propped up by Enron's own shares began to collapse, forcing more losses back onto Enron's books, which drove the stock down further. For a brief moment, there was a possible rescue. In November 2001, a rival energy company, Dynegy, agreed to acquire Enron for roughly $9 billion. But as the scale of Enron's problems became clearer, Dynegy backed out weeks later. With the rescue gone and its credit collapsing, Enron had almost nothing left to hold onto. The fall was astonishingly fast. As one analyst later put it had taken Enron about 16 years to build up tens of billions of dollars in assets, and roughly 3 weeks to go bankrupt. Enron's stock, which had traded above $90 in August 2000, fell to $20 by late October 2001, and then to 26 cents by the end of November. On December 2, 2001, the company filed for Chapter 11 bankruptcy protection with about $63.4 billion in assets, the largest corporate bankruptcy in United States history to that point. The human cost landed immediately and unevenly. About 600 employees lost their jobs, and nearly $2.1 billion in pension plans was wiped out. Many employees had held their retirement savings in Enron stock through their 401(k) plans. As the share price collapsed, those savings collapsed with it. Later, workers won an $85 million settlement in a class-action lawsuit, a fraction of what had been lost. The collapse also destroyed Enron's auditor. Arthur Andersen, then one of the largest accounting firms in the world, had signed off on Enron's financial statements. During the investigation, Andersen employees were found to have destroyed documents related to Enron. The firm was charged and initially convicted, lost its license to audit public companies, and effectively ceased to operate, costing tens of thousands of employees their jobs. In 2005, the United States Supreme Court overturned Andersen's conviction, finding fault with the jury instructions at trial. But by then the firm was already gone. The reversal came too late to save it. Then came the criminal cases against the executives. Andrew Fastow, the chief financial officer who had built the special purpose entities, pleaded guilty and agreed to cooperate, testifying against his former superiors. Another senior executive, the chief accounting officer, also ultimately pleaded guilty. Jeffrey Skilling was charged with dozens of crimes. In May 2006, a jury convicted him on 19 counts, including fraud, conspiracy, and insider trading. Kenneth Lay was convicted in the same trial on multiple counts of fraud and conspiracy. But Lay died of heart disease in July 2006 before he could be sentenced, and under a legal doctrine that applies when a defendant dies before appeal, a court vacated his convictions. In the eyes of the law, those convictions no longer stand. Skilling's sentence was later reduced, and he was released from federal prison in 2019 after serving more than 12 years. The Enron case is not really a story about energy trading. It is a story about the gap between how a company looks and what a company is. The first lesson is about mark-to-market accounting. Recording tomorrow's projected profits as today's earnings is not automatically fraud. It is a permitted method in some contexts, but it creates relentless pressure. Once future profit is booked now, the next quarter must be even larger, and any shortfall between the reported profit and the real cash has to be explained or hidden. Enron's answer was to hide it. The second lesson is about the special purpose entities. Complexity became camouflage. The partnerships were technically legal structures, but they were used to move debt and losses out of view so that outsiders could not see the company's true condition. When the mechanism used to hide weakness depends on the stock price staying high, the company has quietly tied its survival to a number it cannot control forever. The third lesson is about the auditor. An outside auditor exists to be the independent check, the party that tells investors the numbers can be trusted. When that check fails, whether through pressure, conflict of interest, or complicity, the entire system of disclosure loses its foundation. The destruction of Arthur Andersen showed how a failure of independent verification can be as damaging as the underlying fraud. The fourth lesson is about warning signs ignored. A senior insider put the risk in writing, in plain language, months before the collapse. The warning existed. What was missing was action on it. Fraud at this scale rarely happens with no one noticing. It happens when the people who notice are overruled, ignored, or afraid to act. The fifth lesson is written into law. Enron produced the Sarbanes-Oxley Act of 2002, which imposed severe penalties for destroying, altering, or fabricating financial records, required senior executives to take direct responsibility for the accuracy of financial statements, and restricted auditors from selling consulting services to the same companies they audited. The scandal became a permanent change in how public companies in the United States are governed. Enron did not collapse because the energy business failed. It collapsed because the reported picture and the real balance sheet had drifted so far apart that, once anyone looked closely, the distance between them could no longer be hidden. A company can survive bad years. What it cannot survive is the discovery that its numbers were never real. More than 20 years later, Enron remains the reference point for a specific kind of failure, not a business that lost a competition, but an organization that mistook its own reported image for reality until the two could no longer be reconciled. The pipelines were real. The trading floors were real. The awards were real. The one thing that was not real was the financial picture the world had been shown, and in the end, that was the only thing that mattered. This video is for educational and informational purposes only. All information is sourced from publicly available documents, regulatory filings, and credentialed news organizations. Jeffrey Skilling was convicted and later had his sentence reduced. Kenneth Lay was convicted but died before sentencing, and his convictions were subsequently vacated. Arthur Andersen's conviction was overturned by the U.S. Supreme Court in 2005. Source links are available in the description.